In this video, we're going to talk about tax depreciation. As we talked about before, in depreciation, we have to calculate it for GAAP purposes, and we have to calculate it for tax purposes. For GAAP purposes, we need it for our financial statements. And for tax purposes, we need it for our tax return. GAAP is all about expense recognition. We have 4 different depreciation methods. We determine a useful life, and we determine a residual value so that we can calculate the appropriate amount of expense. With tax depreciation, we are concerned about calculating our taxable income. The depreciation methods are either declining balance or straight line, depending on the asset type, as we'll talk about in a few minutes. Useful life is determined by the IRS, by the Internal Revenue Service, and it is done so using the Modified Accelerated Cost Recovery System. There is no residual life allowed in tax depreciation. The entire cost basis must be expensed. So, if we look at tax depreciation, we first have to say, if we have assets that are purchased after September 27th of 2017, then the Tax Cuts and Jobs Act rules must be followed. If we have assets that were purchased before that, then whatever rules we followed when we purchased those assets are the rules that we should continue to follow. Now, the components of the calculation are very similar. We have the cost of the asset, which is invoice cost plus cost of placing in service. It's basically the same as generally accepted accounting principle cost basis. The methods, again, are declining balance or straight line, but it depends on the type of asset. The useful life is going to be determined for us, and there's no residual. So it's a little bit easier to do tax depreciation. Now, for us to actually do this correctly, we would want to follow the rules in Publication 946 of the Internal Revenue Service on how to depreciate property. This document is quite long, but it has all of the information that you would need. The Modified Accelerated Cost Recovery System, or MACRS, is used to recover the basis of most business and investment property placed in service after 1986. MACRS consists of 2 depreciation systems, the General Depreciation System, GDS, and the Alternative Depreciation System, or ADS. Generally, these systems provide different methods and recovery periods to use in figuring depreciation deductions. The General Depreciation System generally has shorter useful lives, and it uses the declining balance method. The Alternative Depreciation System generally has a longer useful life, and it uses the straight line method. Something that's important to remember is that the day that our asset is placed in service is very important under MACRS. So, machinery, equipment, and land improvements uses what's called the half-year convention and the declining balance method. So it doesn't matter when you purchased it during the year, you're going to get a half a year of depreciation in the first year. Buildings, however, uses the mid-month convention and the straight line method. So whenever you purchase it, whatever month it is, you're going to get half of that month as the starting point for your depreciation going forward. Passenger autos have a yearly depreciation limit. So even there we have some special things to remember. We'll talk about those in a little bit. MACRS provides 3 depreciation methods under GDS and 1 depreciation method under ADS. The 200% declining balance method over GDS recovery period. You can use 150% declining balance method, the straight line method, and the straight line method under ADS. So it all depends on what we're talking about. So if we look at depreciation methods in Publication 946, there is a table, Table 4-1, that outlines what is to be used. So GDS using 200% declining balance, the first row in the table, is for non-farm 3, 5, 7, and 10-year property. Farm, 3, 5, 7, and 10-year property placed in service after 2017, in tax years ending after 2017. So it tells you the type of property you're talking about and what method is to be used. So that's a good place to go to if you're unsure. Now, in Publication 946, we have tables for depreciation rates. So here we have Table A-1. It's for 3, 5, 7, 10, 15, and 20-year property using the half-year convention. And it tells you that for each year what the percentages are to be. So that's for half-year convention machinery and equipment. The building, right, uses the mid-month convention. So buildings require that you use a different table. This is Table A7 for non-residential real property under the mid-month convention. Has a useful life given of 31.5 years. And this is the straight line method rather than the double declining method. And so across the top, you have different months placed in service. Now, what is important to remember is that this is the month within your fiscal year. So it is not necessarily, if your fiscal year ends in June, for example, then if you place something in service in May, that's actually month 11. Because that's the 11th month in your fiscal year. June would be the 12th month in your fiscal year. So if you have a calendar year, then the months will match up to their months in the calendar. But it's not always the case. So that's important to remember. Now, if we're going to figure depreciation under makers, we've got 3 steps that we're going to go through. First, we have to determine the cost basis of the asset. Then we have to determine the recovery period or in the method that's going to be used. And then locate the appropriate table to use to calculate the depreciation. So let's say that we're going to buy some new desks. Each desk costs $600 and we have 10 employees. And so this purchase is going to be a total of $6,000. Now the basis then will be $6,000, assuming that we didn't have any other freight and different things like that. So the basis is $6,000. Now this would classify as office furniture, fixtures, and equipment, which under GDS has a 7-year life. And so if we look at this table, the table of class lives and recovery periods, Table B1 from Publication 946, we see here that office furniture, fixtures, and equipment, the first row, includes furniture and fixtures that are not a structural component of a building, includes such assets as desks, files, safes, and communications equipment. Does not include communications equipment that is included in other classes. So under GDS, makers, the second column from the right, you see that our useful life recovery period is 7 years. And so then we need to know, all right, once we have determined the recovery period and the method, we have to locate the appropriate table. And so here we have the table A1 that would be used. So 3, 5, 7, 10, 15, and 20-year property under the half-year convention. So this is 7-year property as we had identified. And so we would use this table and take our cost basis of $6,000 times the year 1 percentage, which in column 7 here is 14.29%. So 14.29% for year 1 times the 6,000 tells me my depreciation should be $857.40. Now, if we are looking at purchasing a building, again, we have to determine first the cost basis of the building, the convention that's going to be used, the recovery period, find the table, and multiply. So let's say that we purchased this building for $15 million. The purchase was made on March 5th, 2020, and our fiscal year ends December 31st. So we're going to use the mid-month convention for this, which is a building, and March, since our fiscal year is a calendar year, March is the third month in our fiscal year. Is it residential or non-residential? Well, this is a non-residential building. It's going to be office space. And so the life is 31 and a half years. So we go to Table A7. Table A7 is non-residential real property, mid-month convention, straight line basis, 31 and a half years. March is the third month, and so column 3 is the month placed in service. And so then we look at this and we say for year 1, we are going to depreciate 2.513%. And so we go to our cost basis, which is $15 million. We multiply it times 2.513%, and we see our expense will be $376,950. So again, we have to know the cost first. Then we have to determine what kind of asset it is so that we know its convention, its recovery period and method. And then we got to find the right table. Once we find the right table and we have the cost basis, the process of calculating the depreciation is not very difficult. Now, a special thing that we have to talk about with regard to depreciation in tax world is Section 179. Here we have a fairly recent publication, that says the IRS issues guidance on Section 179 expenses. And so what are these Section 179 expenses? The second paragraph of this article says Section 179 allows taxpayers to deduct the cost of certain property as an expense when the property is placed in service. For tax years beginning after 2017, the Tax Cuts and Jobs Act increased the maximum Section 179 expense deduction from $500,000 to $1 million. The phase-out limit increased from $2 million to $2.5 million. These amounts are indexed for inflation for tax years beginning after 2018. So let's try to unpackage this and talk about what it means. So in Publication 946, you have a section where it talks about Section 179 as well. The maximum you can elect to deduct for most Section 179 property you placed in service in tax years beginning in 2019 is $1,020,000. This limit is reduced by the amount by which the cost of Section 179 property placed in service during the tax year exceeds $2,550,000. So, what are we talking about? Essentially, Section 179 allows a company to write off the entire cost of an asset in the year they purchase it, which entices businesses to invest, right? So, this cannot be used for buildings. There's a dollar for dollar reduction for asset purchases over $2,550,000. So what does that mean? So let's just say, for example, that the asset costs $2.7 million. Then $1,020,000 deduction is reduced by $150,000. So your deduction that you're allowed is $870,000. So our asset was $150,000 over the purchase limit, which is $2.55 million. So since we were $150,000 over the limit, then our deduction gets reduced by $150,000. So instead of being allowed to deduct $1,020,000, we're only allowed to deduct $870,000. And third thing, the deduction cannot exceed the company's taxable income. So after Section 179, we have another thing, which is called bonus depreciation. So under the Tax Cuts and Jobs Act, companies are now required to take 100% bonus depreciation on the remaining cost of assets after Section 179 depreciation. But you can avoid the requirement by attaching a statement to your tax return that says you're going to not follow that. So Section 179 and the bonus depreciation, it gets a little bit tricky. You can elect to take it, and if you do, then you have to take it for every asset that's in the class of assets that you're using it for. But you can also choose not to follow it and not to do it. Well, why would you do that? Well, this basically allows you to take more expense than you would normally, especially if you're allowed to expense the entire asset in the year you purchase it. But you may not want to do that. A company may not want to take that much depreciation in this year. They may want to save depreciation expenses for future periods to help with taxable income. So all of this, right, would have to be dealt with between the company and the CPA, whoever's doing the tax return for the company. And in terms of bookkeeping, it's unlikely that you are going to be tasked with figuring this out for the business. When it comes to vehicles, got a couple special rules. All vehicles are 5-year property. There are 3 categories of vehicles. You have passenger automobiles, which are 6,000 pounds or less. And with passenger automobiles, there are limits on how much you can expense each year for depreciation. The second class are heavy SUVs, pickups, and vans, which are between 6,000 and 14,000 pounds. And there's a Section 179 limit for SUVs, pickups, and vans, which most recently was 25,500. There aren't Section 179 limits for passenger automobiles, but there are limits on total depreciation. Third category is other vehicles. Vehicles that don't fit into the first 2 categories. And those, if you have them, are treated as machinery and equipment, and would follow the rules of machinery and equipment. So, passenger auto limits. Maximum depreciation deduction for passenger automobiles, including trucks and vans, acquired after September 27th, 2017, and placed in service in 2019. So this is a table from publication 946 again, that's going to highlight how much can be expensed year 1, year 2, year 3, year 4, and so on. A special rule with regard to vehicle depreciation: if a vehicle is used less than 50% for business use, it means it's used for more than 50% of the time as personal use, the company must use straight line depreciation and multiply by the percentage used by the business. So you use straight line depreciation, and then if the business used it 30% of the time, you'd multiply the amount by 30%. So there are special rules. Tax gets complicated because of all the special rules, but the key is to make sure you go to the right place to get the right information. If you can't find the information, then you should contact a CPA if the company that you're doing bookkeeping for is connected with a CPA, and find out the right answers.